It's finally happening, people. The market shift that we've been talking about and dreading and hearing about in the media for months and months and months, well, it's finally here in Metro Detroit. Kind of. Let's get into it. How you doing, guys? Derek here from M1 Realty. I'm the founder of the company, broker owner. I've owned this company since 2014. We started out with me and a laptop on the third floor of an office suite here in downtown Ferndale. Now we're the #1 real estate firm in the city. Got agents waiting on call. Got an all-star team. Whether you're looking to buy, sell, invest, wherever you want to do real estate related, we've got you covered. So I know we've been hearing about this for months, ever since interest rates started going up back in like April or May of this year. And other cities have gotten hit big time with a market shift where, average prices have gone down 20%. There's all kinds of more inventory on the market. Days on market have gone up. People are having to cut prices like crazy to get their house sold. And yeah, we're still not seeing any of that. But we're starting to see a little bit of a shift. So let me talk about it real quick. I'm not going to take up too much of your holiday time, but this is kind of important, so I'm going to tell you about it. So average sale price, is the main metric that we look at when we're talking about whether the market's going up or down. So for the past several years, pretty much without fail, the average price point month over month has gone up and up and up and up. Now, what we're starting to see just over the course of the last few months is our average sale price in Metro Detroit is starting to go down a little bit. Now, this isn't the case in every city. Some cities are, we're kind of all over the place in the metro area. Some cities are still going up, some are stable, some are seeing pretty big declines, a few of them are anyway. But for the most part, most cities, we're seeing just a slight month over month decline in the average sale price that we pretty much haven't seen in quite a while. For instance, between October of this year and November of this year, the average sale price declined about 3%, and that's across the entire metro area. And between those 2 months, we're talking about 7,000 homes that sold. So it's a pretty good sample size. So I do monthly market updates for like certain cities, like I do Clawson every month. And, that's a tiny little city. There could be, 10 sales in a month. So when you're talking about month over month, that's a tiny sample size. So a couple of sales that are kind of outside the average could throw the whole city off. That's not what we're talking about. We're talking about a lot of properties, and it gets even more drastic than that when you go back a couple months. When you go back to August and compare the average sale price in August with the average sale price now, we're looking at a 9% decrease instead of a 3% one. And when you factor in the other metrics that I look at, we can see the market's definitely starting to shift in terms of days on market is going up just slightly. The amount of inventory that we have on the market right now has gone up as well. Currently across Metro Detroit, there's 2.2 months worth of inventory on the market. Now, what that means is if nobody put another house on the market, it's going to take 2.2 months for us to sell off everything that we currently have on the market. And 2.2 months doesn't sound like a lot, and it really isn't in the grand scheme of things. But for much of like the past couple of years, we've been tracking our inventory levels in weeks instead of months. One of the other things I look at is average days on market until the house sells. And currently across Metro Detroit, we're looking at 31 days on average for a house to go under contract. Now, for the past couple years, we were like single digits. I think the average for much of that time was about 9 or 10 days. And just to give a concrete example of that, back in August, the average days on market was 20 days till a house sold. Now it's 31. And obviously you don't need an economics degree to know that the longer a house takes to sell, the less it's generally going to sell for. Typically, the more showings you get, the faster it sells. And the faster it sells, the more money it sells for. Makes sense, right? Well, now we're in a situation where we're not getting showings as fast, so it's taking longer for a home to sell, and consequently, they're going to sell for less money, which is borne out by the fact that houses are selling for less money. So where do we go from here? Now, that part, I don't have a crystal ball. I've been pretty transparent about that, through all these videos that I make. But, we can take, if past is prologue, we can kind of infer where the market's going to head. And as of right now, there's a couple different scenarios that I see as more than likely. Scenario number one is just an extended pause slash slight decline in the average sale price and the market in general. And what I mean by that is, obviously, the Fed has raised interest rates. The whole point of doing that is to kind of put the brakes on the real estate market. I'll be the first one to say, and I have been very clear on this for the past, a couple years of doing these videos, that the market that we were in up until 6 months ago or so was completely unsustainable. You can't have 20% year over year average price increases and expect anybody to be able to afford a house after a while. The reason that was happening was because it was so cheap to borrow money. So, when we're talking, 2.5% mortgage rates, your buying power is just massively increased. Plus, there were a lot more buyers out there than there were houses to put them in. The whole cycle was, self-perpetuating. It was a disaster. It was just very stressful for buyers looking to buy a house. It was really fun if you had a house to sell without having to buy anything else, which is, not that many people. In that case, you're loving life because you're just put a sign in the yard and then just sit back and collect over asking price offers. But for the average home seller, it was tricky because, when you sell your house, where are you going to buy? For the average home buyer, it was incredibly stressful because every house you had to just throw your best offer at people. And, the whole system, the whole market was out of whack. And, I look at it as a bookend to like 2009 when the market was out of whack, and the other extreme, and every third house had a for sale sign in the yard, and people were taking whatever they could get for their house. And at that point in time, it was awesome to be a home buyer because you could pick up a nice house for next to nothing. Obviously we kind of want to be somewhere in the middle. That's a sustainable, predictable market that's good for everybody, and that's kind of what we're shifting to right now. So, in this scenario, interest rates continue to stay. Right now, they're 6.5%, give or take, but that's 4% higher than where we were at the beginning of the year. So, that's having a little bit of a downward effect on the market, and that's totally predictable. And that was actually the goal of the Fed raising interest rates in the first place, was kind of like I said, put the brakes on the market and the overall economy to try and get inflation under control. So, are we going to continue to see 10% decreases every few months? 3% month over month for month after month after month? I seriously doubt it, but it could happen. I think more than likely before too long. It seems like inflation is starting to decrease a little bit. We'll see what happens, but if that's the case, we're going to start seeing, I would imagine here in the next few months, we're going to start seeing interest rates go back down a little bit. In fact, they have not corresponded. For the past 2 times the Fed has raised their interest rates, the mortgage market hasn't gone along with it. So, we're already starting to see that, but we're kind of in place at that 6.5% area. But if all things stay exactly where they're at, there's I'd say even odds chance that we're going to continue to see, prices kind of trend down a little bit over time. At a certain point, the market's going to shift back because if houses get, too affordable, that's more buyers are going to jump back into the market. So it's not like I don't see any scenario where we in our market here in Metro Detroit see a major crash like we saw in 2008, 2009. I'm not saying it couldn't happen. I just don't see it being a very likely outcome. So scenario two is that we're just seeing a seasonal dip in prices. It typically is not uncommon for this time of year for prices to kind of dip down a little bit and then go back up as we head into spring. One variable that we haven't seen traditionally the past several years is rising interest rates as we're entering into a slow time of year. So is that causing things to get worse as far as average sale price? I don't know. It could be. Something I'm definitely going to keep my eye on for the next, month or two until we know exactly how the market's going to shake out. But prices bottoming out in, December, January, or February is typically, what we see this time of year. So it's very possible that this is just, we're seeing just a normal price fluctuation, and they're on their way back up here as soon as March, April, May hits. We're not gonna know until we get there, so I'll definitely report back on that as that happens, though. Now, we're not in the same boat, luckily, as a lot of other cities around the country. Like, I keep talking about Phoenix just because I spend a lot of time there and I'm very familiar with that market. But Phoenix is seeing like a 20% year over year decrease in the average sale price. Our year, we're still up from this time last year. Not by much, but we're like 0.7% above the average sale price of November of 2021. But, we're not, a 3% month over month decrease isn't the end of the world. Even a 9% from August till now, is a little bit more than we'd like to see. But, at the end of the day, it's not some massive crash. So, we're gonna see what happens with our market. I'm fairly confident that the fact that we are still really low on inventory is going to keep prices propped up. But in the grand scheme of things, I'm honestly more encouraged about the real estate market than I have been in quite a while, and I'm going to tell you why. And that's because the fundamentals of the market are starting to get back in alignment with where they should be. So, we talked about the past couple years has been one extreme. 2008, 2009 was another extreme, and we want to be somewhere in the middle where we're starting to get somewhere back in the middle. So it's actually not a bad market for sellers, and it's not a bad market for buyers. So if you're looking to sell your house, true, you're not going to get some, the same scenario that we would have had a year ago where, we would have had, a line down the street of people trying to get into your house to see it and then just give you crazy offers. So, unless your house is absolutely gorgeous, that could happen, but more than likely it's not. So, it's going to take a little bit more work to get your home sold. We're going to have to make sure that it's showing absolutely, its absolute best. We're going to have to make sure that it's priced really, really appropriately. We're not too high, we're not too low. And, expect to keep the house maintained and in proper showing condition for at least a month, because that's the average that it's going to take. If we get it sold in less than a month, then awesome, even better. But, I'm kind of banking on, 30 days being the benchmark right now. So, it's going to take a little bit more sustained effort on the part of the seller and the agent to make sure that it's being marketed properly, it's being marketed in the right places, and you're just maximizing the exposure to the property. The good news is you're still going to sell it for a pretty good price compared to, it's going to sell for more than it was worth a year ago, almost definitely, just based on the trends. And, it's still going to sell pretty fast. And then once you sell it, you actually can buy a place, which I couldn't guarantee that for much of the past couple years. And now for home buyers, well, now you're in the driver's seat now, so this is great. Maybe not in the driver's seat, but you're in a much better position than you were, a year ago or even 6 months ago, because now, inventory is not where it, maybe should be in general, but there's a lot more homes on the market now than there have been at any time in the past couple of years. We've been scraping the bottom of the barrel with inventory before. Now we actually have some houses to look at. So, you go out and look at houses, we're not going to just find one or two to look at where you just kind of have to throw them your very best offer and hope for the best. We can look at 6 or 7 houses. You can take your time. You can find the right place. We can negotiate on the price. We can have it inspected. We can negotiate on the results of the inspection if there's something, deficient with the house. So you're in a much, much, much better place than you have been for the past couple of years. Interest rates, yes, they're higher than they were. Interest rates were being kept artificially low for much of the past, 4 or 5 years, and now they're kind of being priced artificially high, just for that reason that we talked about, to combat inflation. That being said, there are some awesome products that have been around for a while, but they've kind of re-rolled them out because now they're appropriate to home buyers, and one of those being the 2-1 buy down. Now, I did a whole video on that a couple weeks ago, but just for a quick frame of reference, the 2-1 buy down basically is we're going to take, the seller's going to contribute some money back from the price of the house, and what we're going to do with that money is buy your rate down for 2 years. So the first year, say the average interest rate's at 6.5%. First year, your monthly payment is going to be at 4.5%. Now on a $250,000 house, that's going to save you somewhere in $315 a month, somewhere in that neck of the woods. And then the second year, it adjusts up to 5.5%. So that's still saving you somewhere around $175 a month in interest. And then by the third year, the thought is that the the prevailing interest rate is going to be much lower than it is now. You just refinance out of that first mortgage into a fixed rate one that's going to be much lower than what the rates are today. Now, hypothetically, say we're 1 year out from now. You bought a house, you had 12 months where you had a 4.5% interest rate, you're saving all kinds of money. Interest rates drop down to 5%. So your mortgage was going to adjust up to 5.5%. So if the prevailing interest rate in a year is lower than what your rate would adjust to, what we're going to do at that point is just take that remaining, $3,500 or $3,000 or whatever is left from the seller contribution from when you bought your house a year ago, and use that to pay for the refinance. So not only are you just refinancing into a 30-year fixed rate, you know what your payment's going to be for the next 3 decades. The seller pays for it, so it's an absolute win-win. Then the seller gets to have sold their house, they're moving on, doing their new thing. It's just the fact that there's products out there and there's people creative enough to even think it up and find a way to make it work for everybody. I mean, it's just a testament to the professionals that are working in this business. So I guess bottom line, long story short, is the market is starting to correct. We're going to keep an eye on it. I have no idea which way it's going to go, if this is going to be a longer term thing or if this is just a blip and in 3 months we're back up to where we were. Could go either way. Could go a different way that I haven't even thought of or talked about, but we're going to see. Regardless of what happens, you keep watching this channel, you're going to know about it as soon as I do. And again, thank you so much for watching. I love making these videos, and I really love the interaction that I have with people, and the answering questions, helping people out. This is that's why I do this to begin with. So if you ever do need to reach out or have any questions, you can always call or text me at 586-491-5622. You can email me at dwerenka@m1realty.net. I've got my other cell phone is 248-561-6155. Messenger, smoke signal, carrier pigeon, whatever you need to do. Easy to get a hold of, and I'll get right back with you. And I hope everyone has a fantastic rest of their holiday season and a wonderful, prosperous, and happy start to the new year. Looking forward to 2023. I think we got some big things on the horizon, and proud to share those with you as we go. And thank you so much again for watching, guys. Have a great one. We'll talk soon.